Welcome back. Today we are going to see about the introduction of modern banking system, which comes under the modern banking practices subject. Here what we are going to learn is about the banking system, how the banks have enriched themselves to have their business and have their customers in the society and the field. And this is Dr.R.R. Rajkumar, Assistant Professor in Commerce, Bank Management, St.Joseph's College of Arts and Science, Cuddalore. Basics. Before we get into the modern banking practices and the system, we should understand what we mean by bank. A bank is a financial institution that accepts deposits from the public and create a demand deposit while simultaneously making loans. Lending activities can directly performed by the bank or indirectly through capital markets. What this banks are doing is accepting their deposit and providing loans to the customers, and by that they are making some profit, and by this they are creating the indirectly they are creating the capital market. What these banks are really investing for is to give loans to the customers, and through that they are investing themselves by referring to the deposits or loans. In broad way, we can say financial institutions that receive, collects, transfers, pays, exchanges, leads, lends, invests or safeguards money for their customers. Definition is according to the section 5B of Banking Companies Act 1949 defines banking as accepting for the purpose of lending or investing of deposits of money received for the public repayable on demand and withdrawal of check, draft and order or others. These are the basic necessities or basic work which was done by the banking sector, where they can get the people through investing their money or depositing their money, and by this they are creating their capital market by providing their check, demand draft and various services occurred in the banking. In another version of definition is a bank is an organization whose principal operations are concerned with the accumulation of temporarily idle of money of the general public for the purpose of advancing to others for expenditure. This was said by K.P. R.P. Kent. This is the principal organization where they can accumulate the money and uses for the general public, or we can use for the investment of the bank for the enrichment of the public. Evolution of modern banking in ancient countries in Egypt and Greece. Banking or the sector where it was created, where it was started in 2000, later 2000 it was enriched to the technically it was developed. Initially in Rome in the year of 210 BC, it was aside where it was a money changer. It looks like a money changer. In the word bank, it was mentioned as a work. It is a word bank. It comes from Italian word which is known as banco, and it was developed slowly. It was developed in Venice and Bank of England in 1694. It was a central banks, and 1786 generalized bank was there. At last, the Reserve Bank of India Act was passed in 1934. After independence, it was taken over by the government directly, and it was transferred the Ownership Act. The stakeholders of Reserve Bank of India was paid compensation, whereas still in 2024 comes under all the banks or comes under the Reserve Bank of India, which is familiarly we know that. What are the various types of banks? Unit bank means there is a system of bank under which a single banking organization can provide all the services which controls in various places, where the governing body or the board of directors act together and join together and have a banking sector in a single office, where these banks also create their own entity or capital or shareholders and the board of directors. By this they can have their local services, By this, what are the things we can adapt? What are the advantages or disadvantages of unit banks? We can provide local funds for the local people. We can give loans for the local people. Intimate knowledge of the customer. Latest nowadays, every bank is creating or receiving KYC form. Know your customer. Every customer has to fill that form, and every bank should know who are their customers. Efficient management, supervision and control. What are the aspects where we can management is unit banks or creating is they have to supervise and control the money system where it can be useful for the customers and for the banks. Discontinuance of insufficient branches should be closed. Some of the branches which can be done, various branches can be which was not so active, those banks should be closed, and better service has to provided for the every customer. Each and every customer in the banks related to the bank is very important. By this, by giving the better service to the customers, they can create their own business or create their own enrichment of the banking, where they can develop the credibility among the customers. Close banker relationship will be strengthened by customers getting into the bank, and the banker and the customer can get relationship. By this, they can have a continuous service, no effect due to the strikes of closure, like that. What are the disadvantages? Well, we are seeing the merits or the advantages of unit bank. At simultaneously, we have to see the demerits and disadvantages of unit bank. No economics for large scale. Every economy of a country is very important. It should be in the large scale, but the unit banks or the small banks which cannot be able to create more number of customers and create more number of money, and by this we can have a lack in the economic in the large scale. Lack of uniformity in the interest rates. Every bank doesn't have a same type of interest rates for all the banks, for all the customers. By this, these are the some of the disadvantages for the customers, where they can feel some of the banks are giving the low interest rate, and some of the banks are giving a high interest rate. By this, customer can get confused. But these banks should be a change to the uniformity of all the banks in a uniform rate. Lack of control. Some banks should not give a control because they provide more number of loans, more amount of loans to the customers, but they can't able to repay it. By this, they can go out of the control. Risk of banks failure. It leads to the banks failure by the customer by not repaying their loans on time, or not at all paying their EMI in the future. Limited resource will be provided for these banks. No proper facilities or infrastructure will not be given, and unhealthy competitions are also there. By this, it can be created in uniformity of the other banks. Wastage of national resource, because the Reserve Bank of India is giving the most number of resources to all the banks. By this, when there is no customer for a particular branch or a particular bank, they have to close it down. By this, they can disadvantage can give the more number of laggingness for the particular branch. This is what in class we have seen the meaning and definition and the evolution of banks and the types of bank. In next class, we will see about the branches and local markets, how the banks can be established in the future times. Thank you, and you are listening. Thank you for your patience for listening. See you.